All right, stop scrolling for a second because something massive just happened in silver, and it's not the kind of move you ignore. In a single session, silver collapsed from near $120 down to about 78. That's roughly a 30% crash, tens of billions in paper value gone in hours. And now, today, it's ripping higher again, up more than 12%, trading around $90 an ounce as we speak. At the same time, the US just announced a $12 billion strategic critical minerals stockpile, and they're hosting a ministerial with more than 50 countries. Both the market and policymakers moved at once. That's not random. Stay with me because I'm going to show you what actually caused this and how you can spot these setups before the crowd does. Before I explain what triggered the crash and the rebound, let me teach you something most people completely miss about markets like silver. Silver isn't just a metal, it's a leverage machine. And here's what I mean by that. Silver lives at the intersection of futures, options, ETFs, and physical supply. When prices rise fast, leverage builds quietly in the background. Traders pile in with borrowed money, margin requirements feel cheap, and everyone feels smart. It's like stacking kindling in a dry forest. Nothing looks wrong until a spark hits. And when it does, the selling you see isn't opinion-based selling. It's forced selling. Computers don't care about fundamentals. Brokers don't care about narratives. They care about margin. Once you understand that, these violent moves stop feeling mysterious. They start feeling mechanical. So what does that tell us? It tells us that when you're watching a commodity like silver move this fast in either direction, you're not just watching supply and demand. You're watching leverage unwind or rebuild. And that's a completely different game. Think of it like this. If you've ever seen a row of dominoes fall, you know that the first domino doesn't need to be big. It just needs to tip. In silver, that first domino is margin. When margin requirements go up, traders who are stretched suddenly have a choice. Post more cash or get out. Some can't post, so they're forced out. And when they're forced out, they push price down, which triggers the next trader's margin call, which forces more selling. That's the cascade. And once it starts, it doesn't care about your thesis or your conviction. It cares about math. If this is making sense, drop a comment below and let me know if you've ever been caught in something like this, because I want to hear your perspective. Now here's what's actually happening under the hood. Silver ran hard, fast, and crowded. As prices pushed toward $120, exchanges responded the way they always do in overheated markets. They raised margin requirements. That's the primary driver. Let me walk you through exactly how this works. When margins go up, leveraged traders suddenly have to post more cash or get out. Some can't. Positions get liquidated automatically. That initial selling pushes price down, which triggers more margin calls, which forces more selling. That's the cascade I just mentioned. But here's where it gets interesting. This isn't a one-time event. This is a feedback loop. Every tick lower creates more stress, which creates more liquidations, which pushes price lower. And the speed of it? That's what shocks people. You can go from a controlled market to a free fall in minutes. Not days, minutes. And when I say minutes, I mean that literally. Look at the intraday charts. Silver went from 117 to under 80 in a matter of hours. That's not natural selling. That's not people waking up and deciding silver's overvalued. That's systematic liquidation. Now let me give you some context on why margin hikes are so powerful. When you're trading futures, you're not putting up the full value of the contract. You're putting up a fraction. Let's say 10% or 15%. That's your margin. If silver's at $100 and you control one contract, you might only need to post $15,000. But if the exchange suddenly says we're raising margin to 20%, now you need to post $20,000. If you don't have that extra $5,000 sitting around, your position gets closed. And here's the thing. When prices are rising, nobody complains about margin. Everyone's making money. But when prices are rising too fast, exchanges get nervous. They see concentrated positions, they see leverage piling up, and they act. It's a risk management tool for them. But for traders on the other side, it's a trigger. But here's the part that should make you pay attention. During this liquidation wave, reports hit that JPMorgan had closed significant short exposure near the lows. At the same time, systems at the London Metal Exchange and even HSBC experienced temporary outages. Now, I'm not saying there's a grand conspiracy here. I'm really not. But I am saying that stress shows up first in plumbing. When infrastructure creaks while price is crashing, that's your secondary confirmation that this move is mechanical, not fundamental. Let me explain why that matters. If this were a fundamental repricing, you'd see orderly selling. You'd see volume build gradually. You'd see people reassessing their thesis over days, not hours. But when you see systems go down, when you see major players suddenly covering positions at the lows, when you see the kind of volatility that breaks normal trading patterns, that tells you something else is going on. It tells you the market structure itself is under stress. And here's what very few people are talking about. The London Metal Exchange has a history of this. Back in March 2022, nickel went absolutely insane. It squeezed so hard that the exchange literally canceled trades and shut down trading. Why? Because the system couldn't handle the move. The plumbing broke. Now, I'm not saying that's what happened here with silver, but I am saying that when you see these kinds of technical glitches and outages during extreme moves, it's a signal. It's a signal that the market's infrastructure is being tested. And when infrastructure gets tested, weird things happen. Prices gap, liquidity disappears, and the people who are most levered get hit the hardest. So you've got forced selling on one side. But now let me show you what most people are missing on the other side. While paper silver was imploding, policymakers were doing the opposite. The US rolled out Project Vault, a $12 billion strategic stockpile for critical minerals, and silver is squarely in that conversation. At the same time, the EU floated a minerals partnership, and Washington is hosting a room full of ministers talking supply security. So think about what that means. You have forced selling in the paper market, driven by leverage and margin calls, and you have policy-driven demand in the physical market, driven by geopolitical strategy and supply security concerns. When those two collide, you don't get a clean trend. You get air pockets, snapbacks, and a repricing process. That's why today's bounce matters. It's not just a bounce. It's a signal that physical and strategic demand is leaning against paper liquidation. Here's another way to think about it. Paper markets can move fast because they're leveraged. Physical markets move slower because they're real. When paper crashes and physical demand stays firm, eventually they have to reconcile. And that reconciliation process, that's what we're seeing right now. The paper market said silver's worth 78. The physical market and policymakers said we're still buying. And now price is finding a new equilibrium somewhere in between. That's the convergence proof I'm talking about. Now, before we go further, let me give you some historical context because this exact playbook has happened before. Zoom out and look at oil in the 1970s. Once it moved from commodity to strategic resource, volatility exploded, but the price floor ratcheted higher. In 1973, oil was trading around $3 a barrel. Then the embargo hit. Oil spiked to over $10. Then it crashed. Then it spiked again. By 1980, it was over $30. The point isn't the exact numbers. The point is the pattern. Once oil became strategic, once governments started talking about reserves and supply security, the volatility went through the roof. But every crash found a higher low. Every spike found a higher base. The market was repricing oil from industrial input to geopolitical weapon. That's a fundamentally different asset, and the price behavior reflected it. Every time you thought oil was done, it came roaring back. Not because of supply and demand fundamentals in the short term, because of strategic positioning in the long term. Or look at gold after 2008. Central banks didn't stop corrections, but they changed the long-term trajectory. Gold was around $800 an ounce before the financial crisis. It spiked to over $1,000. Then it pulled back. Then it rallied again. By 2011, it hit 1900. The path wasn't smooth. There were brutal corrections. 2012 to 2015, gold chopped around and eventually bottomed near 1050. People said it was dead. But then what happened? Central banks kept buying. Policy kept shifting. And gold found a new floor, then broke out again. By 2020, it was over 2,000. Same pattern we're seeing today. When a commodity transitions into the strategic category, it doesn't behave politely. It overshoots, undershoots, and then settles at higher nominal levels. The volatility scares people out, but the strategic demand keeps pulling it back. Or let's go even further back. Look at what happened with palladium in the early 2000s. It was a niche metal, mostly used in catalytic converters. Nobody cared. Then Russia, which controlled a huge portion of supply, started holding back exports. Suddenly, palladium wasn't just a metal, it was strategic. Price went from $150 an ounce to over $1,000 in a few years. Then it crashed. Then it rallied again. The point is, every time a market shifts into a strategic category, the rules change. Volatility becomes the norm, not the exception, and the price floor keeps rising because governments and institutions don't think in quarters. They think in decades. When you look at silver through that lens, this move stops looking insane and starts looking transitional. The larger story here is a metal being reclassified in real time. It's moving from industrial commodity to strategic resource. And if that's true, then the volatility we're seeing isn't a bug, it's a feature. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a blow-off top followed by a dead cat bounce? Absolutely. Could some of the chatter about manipulation be overstated? Of course. Markets don't need villains to break. Leverage alone can do that. I've seen it happen in crude oil. I've seen it happen in copper. I've seen it happen in wheat. You don't need a conspiracy. You just need too many people on the same side of the trade with too much borrowed money. And when the tide turns, everyone rushes for the exit at the same time. That's enough to create chaos. So yes, it's possible that silver just ran too far too fast, got overheated, and is now retracing. It's possible that this bounce is just short covering and bottom fishing, and that the real move lower hasn't even started yet. I'm not dismissing that, but here's the thing. It doesn't actually matter whether there's manipulation or not. It doesn't matter whether JPMorgan's intentions were good or bad. It doesn't matter whether someone pulled strings behind the scenes. What matters is the mechanics. What matters is what you can see and what you can measure. The mechanics are what matter. Focus on what you can control. Can you control headlines? No. Can you control whether people speculate about manipulation? No. Can you control whether price holds key levels, whether volatility compresses or expands, and whether policy signals keep stacking up? Yes, that's where your edge is, not in arguing motives, in watching mechanics. There are probably 3 types of people watching this right now. The first type is shaken. You watched silver drop $40 in a day and thought, I never want to touch this again. That reaction is human. It's normal. You got hurt, or you watched others get hurt, and now you're spooked. And honestly, that's probably the healthiest reaction in the short term. For you, the lesson isn't about silver specifically. The lesson is about position sizing and understanding leverage before you need to. If a 30% move in a day wipes you out, you were too concentrated or too levered. Period. The market just taught you that lesson the hard way, but don't let that scare you away from learning. Use this as a case study. Study what happened. Study why it happened, because this won't be the last time you see a market do something like this, and next time, you'll recognize the setup earlier. The second type is excited. You see 90 after 78, and you're thinking, this is the bottom, load up. Slow down. I get the impulse. I really do. It looks like a gift. It looks like the opportunity of the year. But here's what you need to understand. Catching falling knives is dangerous. Even if you're right about the bottom, the path back up is rarely smooth. You might be right, but early. And being early can hurt just as much as being wrong. Your edge isn't adrenaline. Your edge is patience and confirmation. Wait for the market to show you it's stabilized. Wait for a higher low. Wait for consolidation. Wait for the panic sellers to be completely flushed out. If this is a real bottom, you'll have plenty of time to get in. And if it's not, you'll save yourself from averaging into a losing position. There's no medal for being the first one in. There's only returns. And returns come from discipline, not heroics. The third type is experienced but cautious. You've been through this before. You've seen markets melt down and melt up. You're not panicking, but you're not rushing in either. You're trying to separate signal from noise. For you, the focus is structure. How does price behave around 85 to 90? Does it consolidate or does it roll over? Whether 95 to 100 gets reclaimed matters. If it does, psychology changes fast. If it doesn't, then this might just be a bounce in a bigger correction. And whether panic lows stay intact matters. If silver goes back under 78, that's a different story entirely. Different paths, same principle. Let the market show its hand before you push your chips in. You've survived this long by not being impulsive. Don't change that now. So here's what I want you to answer in the comments. Which type are you? Are you shaken, excited, or cautious? And what's your plan from here? I'm genuinely curious because your perspective matters, and I think the community benefits when we share honest reflections. So here's where I stand. I'm not euphoric and I'm not bearish. I'm alert. Let me tell you what I'm personally watching. First, I'm watching whether silver can hold the 85 to 90 zone, because that tells you whether today's move is absorption or just reflex. If price consolidates here, if it builds a base, if you start seeing buying come in on dips rather than just short covering on rips, that's a signal. That tells you there's real demand underneath. But if price can't hold and starts leaking back toward the 70s, then this was just a bounce, not a reversal. Second, I'm watching the 95 to 100 area. Why? Because reclaiming that puts silver back in global parity with where it was before the crash. And that changes psychology fast. Traders who got stopped out start thinking about getting back in. Institutional players who were waiting on the sidelines start deploying capital. And momentum shifts. But if silver can't reclaim that level, if it stalls out in the low 90s and rolls over, then the market's telling you it's not ready yet. Third, I'm monitoring policy headlines and physical demand rhythms, not tweets. I'm watching whether mints report shortages. I'm watching whether premiums on physical silver stay elevated. I'm watching whether governments actually follow through on these stockpile announcements or whether it's just talk. Because this crash was mechanical, not emotional. The policy backdrop is structural, not temporary, and if those two realities stay in place, then I think we're in for more volatility, but a rising floor over time. Based on my analysis, this event was technical and structural, not fundamental. The fundamental picture for silver hasn't changed. Demand for solar panels, electric vehicles, and electronics is still growing. Supply is still constrained. Central banks are still buying gold and diversifying reserves. And now, on top of all that, you've got governments talking about strategic stockpiles. Those are real tailwinds. What happened in the last few days was a deleveraging event in the paper market. It was painful, it was violent, but it doesn't erase the underlying story. If history rhymes and silver consolidates above 85 and reclaims the mid-90s, the move that follows could be significant. Not because I'm predicting it, but because that's what the pattern suggests. That's what happens when paper liquidation meets physical demand and strategic positioning. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at the margin requirements. Look at the policy announcements. Look at the charts. Don't just take my word for it. Your money is your responsibility. What I'm giving you here is a framework. I'm showing you how to think about these moves, not what to do with your capital. That decision is yours and yours alone. If you made it this far, you're in the top 1% of people actually trying to understand markets instead of just reacting to them. That mentality will serve you well. It'll keep you calm when others panic. It'll keep you cautious when others are reckless. And it'll give you the ability to spot opportunities that most people miss because they're too busy being emotional. If this breakdown helped you see silver differently, hit that share button and send it to someone who needs this perspective. Subscribe if you want more breakdowns like this, where we cut through the noise and focus on what actually matters. And drop a comment with your biggest takeaway or your current read on silver. I read every single one, and your insights make these videos better. This is how you stay ahead. Not by chasing headlines, not by following hype, but by understanding mechanics, watching structure, and letting the market show you what it's doing before you act. Stay sharp out there, think critically, verify the data, and make your own decisions.